Welcome, you're listening to the best of investing on Talk 910. You know our show. It's where we present valuable information about real estate, the financial markets, and other economic business of the day. And for those of you listening for the first time, here's our format. A few guys sitting around a bar having drinks, or without the drinks, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender, and Robert Spinoza of RPM Mortgage. So now we're going to cut to the second commercial trivia question break. Okay, again, the theme is baseball teams in the movies. In the movie Major League, which Major League Baseball team was featured? The first three callers with the correct answer to that question are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Don't touch that dial. The best of investing will be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, and Rob Spinoza of RPM Mortgage. When we cut to the second commercial break, we asked this trivia question. In the movie Major League, which Major League Baseball team was featured?
Cleveland Indians.
The Cleveland Indians.
Yes.
That is correct. Chief Wahoo. Remember that? Okay. Now, Rob, we got an email for you that I thought was very interesting.
Okay.
It says, I have a home equity line of credit on my home.
A HELOC.
A HELOC, yes. That I took out a few years ago.
Okay.
I'm concerned about rates going up, and I forget how the changes to the payment work.
Yeah, it's a very, very good
Please
question.
explain that.
Very timely question, and here's why. Like we just said, it's 2014 now. That means 10 years ago it was 2004. And 2004, 2005, we saw the greatest preponderance of these home equity lines of credit made because at that time it was very easy to get one. You didn't need much. You needed a good FICO score, but chances are you'd already been through the process on a refinance. And so you had a recent appraisal. Values were going up. Banks were eager to lend this kind of money, and everybody could get one. It was quite accessible. So a lot of people have these second mortgages. Then what happened is property values went in the wrong direction. Banks froze them, and you ended up with a first mortgage and a second mortgage, sometimes being underwater on the second, if not the first. So here we are 10 years down the road, and a lot of borrowers have whatever amount they have on that line of credit. Let's say it's $100,000. And one of the other great features of these programs was that when they were often made at a margin at or below prime rate. Prime rate is currently 3.25%. So some of these people are paying 2.75% on $100,000, and they're making interest-only payments on that.
They're loving it.
They're loving life right now, but they know that there's this, boogeyman out there that's coming. He's lurking in the shadows, and in fact, often on the 10-year anniversary, what happens with these lines of credit is they become amortized loans for the remaining period of the term. So if it was a total 30-year term and you've had 10 years of interest only, now you take that $100K in our example and you amortize it over 20 years, not 30.
Ouch.
Yes, and
Wait, did they lock the rate in?
No, most of the time the rate is not locked. Many of these programs did feature a lock-in feature for a segment or all of the balance, but the rate was unappealing at the time.
Okay.
But now, of course, borrowers are concerned with the Fed making a move with the tapering of the bond buying and things like that. The rates could be going up, and their 2.75% could become 8.75%. Again, amortized over 20 years or whatever it may be. So what I suggest on these is if you're in this position, if you have a home equity line of credit, if you're uncertain of how it will look, great opportunity to give me a call, no cost, no obligation. We'll take a look at the note, which is the document you signed at close. We'll look at how it will convert, and I'll give you some examples of what you might expect with your payment changes. Not a lot of doomsday stuff, but just realistic scenarios over the next few years of what you can do to mitigate any changes and to make the repayment of that loan more palatable.
It's interesting. All this other stuff we were talking about,
Mm-hmm.
Dawn had no interest, and now you start talking about this home equity line, she's looking right through the window at us, and suddenly her ears are right up against the window.
Yeah, I think she's not going to be the only one with that because it's getting a lot more press, but it is something that if you've got a line of credit. One other thing about this too, if you have, and this is without getting too technical, if you've got a first and a second mortgage and you try and refinance the two together, a lot of times a bank, a Fannie or Freddie bank will consider that a cash out refinance, even if you're not getting any cash back. But some of our new jumbo programs, actually, if you've had no activity on the line of credit in the last 6 months, they count it as a rate and term refinance, which means your loan to value can be higher And with recent increases in home values, you may have an opportunity to consolidate this at a lower rate than you're currently paying.
Why don't the banks just amortize it over 12 months? Then they'll be really
Well,
safe
then you
with
talk
the
to
loans.
Mark. No, you do have
Payments are only about $40,000 a month, but that's okay.
but you'll get rid of the debt.
Yeah, that's right.
One way or another.
Fast.
Yeah. No, so it's a good time to discuss it. Don't let it get ahead of you. Be proactive. It's not going to go away. There's very little appetite for restructuring or bailouts anymore. Get a grip on it, and I can help you do it. I'm with RPM Mortgage. I work out of the Mill Valley office. Feel free to get in touch, and I'll help you understand.
Okay, we have audiences all over the place. And the thing is, even though you're in Mill Valley,
Yeah.
most of the stuff can be done either over the phone,
Correct.
or
Correct.
You know,
And I can help anyone in California, but this is the kind of thing where I'm an expert at this. You call me, we'll take a look at your note, and I'll be able to give you some quick figures real fast, and you'll get a better grip. It'll make you feel better about what changes could occur.
What kind of new home equity loan products are on the horizon?
They're out there. Most of them are not extremely aggressive with their combined loan to value, although relative to hard money, I would say it is aggressive. 90% loan to value is about the most you're going to see a lender do. So if you've
That
got
is pretty aggressive.
Yeah, it's pretty aggressive, and we make those loans now concurrently with a purchase money or a refinance first mortgage. We don't make standalone home equity lines of credit right now.
Oh.
But I suspect if things continue to move in the right direction, that we might venture back into that. Your local credit unions and some banks do specialize in the standalone home equity lines of credit. So basically, I've got a mortgage, I want to get a line of credit, I go to my bank, fill out an application, and we see if they'll make one for me. And then those are out there, and they're coming back stronger.
And then the Dodd-Frank regulations that have gone into effect, does that mean that on a home equity line of credit, they have to qualify in terms of ability to repay or income qualification?
You go explain the logic on this, but second mortgages are exempt from Dodd-Frank. Don't know how that works, but what I will say is that if you're a first mortgage lender, one of the key provisions of Dodd-Frank is ATR, or ability to repay. So if you know there's a line of credit, or there will be, you've got to take that payment into consideration.
I think more specifically, it's the home equity lines of credit that are exempt from still exempt from the Dodd-Frank
Right.
rule, as opposed to like a hard money second, because I know that we
okay.
at Pacific
Yeah,
Private
it's
Money,
interesting.
we get requests frequently from people who live in their home, have lots of equity, and want a quick and easy privately funded, hard money loan, and we're not able to accommodate them because of the onerous predatory lending
That's
laws
interesting.
that
I did not know that.
yeah, that have been enacted over the last several years. Now, of course, if we did a home equity line of credit, and we could, they would be exempt. But the interestingly, Dodd-Frank has a rule that you can't just offer a home equity line of credit. You also have to offer a closed-end product, as they call it.
okay.
So you have to have
Yeah.
both, and then you have to qualify them on each. Anyway, it's just a big headache, and most of us
And
don't
so
do
on
it.
and so forth.
Yeah, that kind of
and
prices you right out
that
of the
touches
market.
right on the core of the issue, is that with these regulations, the overlaps, then you start dealing with the amount that they are over prime offer rate. You start dealing with all this stuff. Lenders are reluctant to make these loans because they start to collide with all of the provisions of the Dodd-Frank bill. It gets very complicated very fast, and it's too risky. And I think it limits consumer choice.
Well, it's really too bad because, as we've talked many times on this show, all of these regulations only serve to eliminate consumer choice. And now that I'm not saying that it doesn't protect the consumer; it does, but it really protects them from themselves, because most predatory lenders have been long out of business. I'm not saying that they're not out there still. There are still some people operating under the radar, but for the most part, I mean, subprime disappeared after
The quality of
2008.
loans that we've made over the last few years is just stellar. I have to really back that up and say that the quality of borrower, those that have been eligible to get a loan and do anything in this low rate environment, has been so selective. To add these regulations on top of that, to me, seems like it's locking the barn door after the horse has been out. And it's yet to be seen how it's going to play out in 2014, but I think the timing is poor, if not the regulations themselves.
Well, clearly access to capital is going to be more difficult in 2014 than even 2013. We didn't name it specifically, but there is a term that consumers will hear more and more in 2014, and that is the so-called qualified mortgage, or
Right,
QM. So a qualified mortgage is a term that is beginning on January 10th for the lending industry, and it's guidelines under which we can make consumer purpose loans, and it's all in the guise of protecting the consumer from the big bad predatory lending banks and other institutions and private and hard money lenders. All have been put into one category. Those anywhere where you can get a loan as a consumer is impacted by these qualified mortgage, and it does many things, but one of the primary things it does is you have to be able to demonstrate to the lender your ability to make the payment. So if you're self-employed or if you've got inconsistent income, you're going to find it you're going to find it more difficult than it already was to get bank financing or even private financing.
If you have a pre-approval, if you're looking to buy a home in 2014 and you worked with a lender now in 2013 and you're crossing this January 10th deadline, I highly encourage you to get back in touch with your lender and make sure that your pre-approval holds when measured against the Dodd-Frank regulations. I've done this with the pre-approvals I have in the pipeline, and I think if you're a real estate agent listening to this program, every pre-qualified buyer that you have, you need to circle back with them and make sure they've done the same thing. I think this thing is going to come up in the real estate industry when it begins to directly impact people. Right now, it's just this idea that's out there that hasn't been fully implemented across the board. But when it does, we're going to see changes and some people pushed out who were otherwise eligible. It's unfortunate, but do what you can to be proactive about it. Talk with your lender and make sure you're in a position to roll with these punches when they come, because I don't want to see the real estate market taper off. I think it's crucial for the benefit of our economy.
Otherwise, you're going to have to go to a pawn shop and get
Well,
your loan there.
CFPB's on them too.
Oh, yeah, all these initials, you guys, ATR, isn't that
Yeah.
the kind of dune buggy on the sand?
And that I don't know about.
Oh, that's an ATV. ATV. Or an ATM machine? Oh, no, that's all. Okay, ability to repay. Okay,
Yeah.
that's a new one. All right, we're going to cut to our third and final commercial break. Here's the trivia question. Again, the theme is baseball teams in the movie. Baseball in the movies. In the movie Rookie of the Year, which Major League Baseball team was featured? And if you remember, this is the one where Jason Robards... No, I'm sorry. That's a different one.
Yeah.
That's the first one. This one, the kid gets a broken arm, and his arm gets all wound up, and he can throw like 100 miles an hour. It's kind of cute. It's a very silly, fun movie, though. In the movie Rookie of the Year, which Major League Baseball team was featured? Don't touch that dial. The Best of Investing will be right back with some closing comments. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, the fastest growing private lender in Northern California, and Rob Spinoza of RPM Mortgage, the brilliant mortgage broker.
Been called worse.
Yeah, other than brilliant, I would think so. Okay, here's the final commercial trivia question break. Again, the theme is baseball teams in the movies. In the movie Rookie of the Year, which Major League Baseball team was featured? Anybody?
Cubbies?
The Cubby, the Cubs.
Oh, wow,
the
Mark's
Chicago
rolling
Cubs.
there.
Yeah, he's a man. Okay, Rob, you want to end us on a positive note?
Yeah, I think that's appropriate. It's fitting for the start of 2014. We've talked a lot last segment about how the changes are, could be potentially harmful. But let's talk about what's been great over 2013. Nearly half of states are within reach of their peak home prices, peak being defined mostly as 2006. 5 states have seen the highest home price appreciation year over year. Nevada, 25.9%.
Well, yeah, because they dumped, 180%.
All right. California, 22.4%. Yeah. Let's just leave it at that. I think that's impressive, certainly here in the Bay Area.
And are these average median price increases?
What does it say here? While you talk about that, I'll figure that out for you here. But,
well, you got to figure the ones that drop the most were going to come back the most.
It doesn't specify.
Yeah, it doesn't specify.
I'm guessing it's median because that's usually what they use.
Like specifically Las Vegas and Nevada, or just,
no, they don't break it out by city. Yeah,
Phoenix
and then last another report by Zillow, the national negative equity rate fell at its fastest pace in the third quarter of 2013, dropping
like
to 21% of all homeowners with a mortgage.
Well, and that is all good news, and that is, essentially reflects the double-digit appreciation we had in most markets last year in real estate. So fewer people underwater. Although, as I mentioned earlier, 2 million homeowners in California, and that's not an insignificant number,
Right.
are still at or near underwater. So we're, those folks still need home prices to go up still, significantly in the next,
How much
couple of years.
underwater are they? Do you have any statistics?
It includes, the 2 million includes people that are near, that are at or near zero. So I
Okay,
think,
so
I think
within
that includes
10%,
like
let's say.
within 10%, right, exactly. Because again, if you don't have at least 10% equity in your home, you can't sell, because if a real estate commission is 6%, plus closing
yeah,
costs are
exactly.
another 2. I mean, I
Yeah.
use a 10% number on average as a cost to sell a home after you factor in everything that escrow charges you when you sell a property, including that new tax that they're talking about if you're a real estate investor on that's going to affect this year. But that's for another show. But it's interesting. There was a recent article in the San Francisco Chronicle where the first line of it said real estate investors who were a potent force in the Bay Area market during the housing downturn, which of course I agree with. They are rushing to lock up deals before rising home prices wipe out their chances for profits.
Doesn't that kind of sound like 2005 all over again?
Well, first of all, I don't agree with that, how that sentence ends. I don't think that rising home prices ever wipe out chances for profits.
Right.
I mean, that's just silly. I've
There's
said
a
it.
ceiling up there.
Right.
Yeah.
I've said it once and I'll say it again. It is always a good
With me.
time to invest in real estate. There's never, I mean,
You should
if
be choosy.
you can make a bad purchase if you don't know what you're doing.
Yeah.
But if you know what you're doing, there are always opportunities to add value to real estate. Now, we're not talking about buying a home, sitting on it, and hoping appreciation or rising markets in and of itself will
Yeah.
create an opportunity for you to make a profit. We're not talking about that. When I talk about buying, fixing, and flipping, the fixing part is the most important part of that.
Yeah.
Is
Kitchens and bathrooms.
in addition to buying correctly, not overpaying for the property.
Yeah.
So you need to identify an opportunity, make sure your numbers are accurate, add real value.
But don't just
and
build
then,
pools and
right,
stuff.
and then sell it quickly. And quickly is usually within 4 to 8 months. And if you do all of those things correctly, it doesn't matter what's happening in the real estate market, whether it's rapidly rising, slowly rising, flat, or even going down. You can still make a profit, in a 12-month period in real estate investing. So again, I just find it interesting how the media oftentimes misrepresents opportunities in real estate.
Well, okay. Any last comments there before we cut to our thoughts for the day?
I don't have any for you.
Okay,
No, I think
here's
we're
to a
covered quite bit of
prosperous
ground.
2014.
Absolutely,
Huh?
yeah.
I think it will be a good year.
It is going to be, well, and one of the other things that are going to impact it is we'll see how jobs go and how incomes go.
Right.
Yeah.
That there is a lot of consumer confidence going into 2014, and so if we can see job creation and income growth, those are two of the most important factors in affecting real estate, and we need that to have a booming real estate market.
I do have to say, I was listening to Armstrong and Getty a couple of days ago on the same station that we're on, 910, Talk 910. And it was funny, there was some statistic that said that 83% of the young Democratic voters are in favor of the Affordable Care Act, but
Yeah.
only 50% of them are in favor of Obamacare. What they don't realize is that it's the same thing, it's just under a different guise. Okay,
Oh, funny, that's great.
here's our thoughts for the day. When tempted to fight fire with fire, remember that the fire department usually uses water. Of course, and an axe. But I'm not sure how that would affect it. Okay, and to be sure of hitting the target, shoot first and we'll call whatever you hit the target, right? That's what I always do. Makes me 100% accurate then, right?
There you go.
Okay, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.
I know my mic works. My mic works.
Can I flick that thing? You ready? Okay.
Mike.
Everybody ready? This is the fun show. The other show we do is a little more
Just by the way,
serious.
before you go, if I have to leave
I was like, the sports show can't be not fun.
should I just
You know
stand
what?
in there?
Yeah, go ahead and stand over there.
Yeah,
now.
you might want to.
Yeah,
So I'll put my briefcase in there too.
that's what's smart. Okay. Away we go. Welcome. You're listening to the best of investing on Talk 910. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. And for those of you listening for the first time, because we do have a lot of new listeners, imagine a few people sitting around a bar having drinks without the drinks, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hahn of Pacific Private Money, California's fastest growing private lender, and Catherine Harris of Parati and Karad, CPA. And we always have to have a CPA on here to, kind of elevate the intelligence.
'Tis the season.
Yes, yeah, that's true. It is tis the season.
Yes, it is.
Our phone number is 888-912-1190. Write that number down. 888-912-1190 because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, 916-777-5511. Today's trivia theme is #1 music hits of the 1980s.
Okay.
Okay. Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. Also, we're on television, Comcast Channel 26 and AT&T Channel 99 on Saturdays at noon and Sundays at 6 p.m. Today we have a special guest, Dawn Fitzpatrick, and she's going to discuss with us FEMA insurance and the effects on small business. Dawn, welcome to the Best of Investing.
Thank you, Edward.
Okay, go ahead and speak really loud in there. Okay. Now, the reason we have you on the show is because you have had some experience with a business with FEMA. Explain what's going on.
Well, recently the rules changed for FEMA, the regulations changed. And we have a property, it is a business in the Delta, and we were informed that we needed to have flood insurance. We really didn't think it was going to be too much of a problem until we got the premiums. An example, one of our buildings is an estimated value of about $10,000, and FEMA is requiring that we place $5,000 immediately in this escrow account, and the premium is $1,750. So
A year?
A year. So within a very short period of time, you can see we're going to hit the value of the property. We talked to the lender, and they said their hands are tied. This is a new regulation. And they're going to try to work with us, but point being, if the regulation came down and this is a new requirement, and the premiums, I'm assuming it's not going to be just for our specific property or business. It's going to be straight across the board for other businesses and homeowners probably.
That are in flood zones.
Exactly.
Okay.
So how are you going to manage this this cost? How are you going to absorb the cost?
Before we went on air, you had explained to me about how the one person, what did their premiums go to for their own house?
Well, I've heard stories that they've gone up from just regular hazard insurance of about $1,200 a year to now with the flood insurance requirement about $12,000.
Oh,
My God.
1,000.
That makes you rethink whether you wanted to buy that house or not.
Yeah.
Well, they've owned it for years,
yeah.
never had a flood, never had an issue, but now this is a new requirement. So again, how does that family absorb the cost? They in most likelihood can't. What bills do you not pay so that you can pay your FEMA flood insurance?
So are you talking about an existing loan where you already previously had been required to carry flood, and the flood insurance now, something has happened to the industry where flood premiums have gone through the roof?
Well, that is one instance, but there is cases where you didn't have to have flood insurance in the past, and now with the new requirements you do. They've changed the mapping. They've
Is
changed
that what it
all
was?
sorts-
I was going to say,
Yeah.
why all of a sudden where you didn't have to have it 1 year, 10 years, 20 years, and now all of a sudden it's the change in the mapping.
That's
and
right.
How they determine what is a flood zone.
That's right,
Is
and
that
they
what it
have
was?
something called flood certificates, and so that's how they determine the mapping. So you may have not had to have flood insurance, your mortgage company didn't require it, and now with the new regulations they do.
So it must be in the deed of trust that I guess it says if you are deemed to be in a flood zone, you will carry flood insurance. Now, of course, most properties are not in a flood zone, so you look at that language and you just ignore it like it's not there.
Exactly.
That's exactly correct. Why would you need
And,
to?
and didn't you? I remember you telling me before. Didn't someone their premium went up to like 50,000?
In some cases, absolutely. And these are in areas where I think the state's absorbed a lot of damage due to
Katrina.
exactly due to natural hazards, and so now they're spreading the premiums differently for everyone
Across the country.
Exactly.
That's what they have to,
That's
to
amazing.
absorb that cost.
Can you imagine how many foreclosures there may be? I mean, I'd like that family, let's say going up to 12,000, you know, that may or may not make the difference for them if they're, let's say, on the cusp of being able to barely make their mortgage payment.
Well,
exactly.
when you had to pay only $1,200 to $12,000, I
Exactly.
mean, that percentage increase is, and a percentage increase from $1 to $100 is one thing.
Yeah.
But when you're going from $100 a month to
$1,000
$1,000
a
a month,
Yeah.
that has an impact on most families.
Well, in businesses as well, we're looking at the same thing. We can't absorb the cost of that, and that was just one building. We have 5 buildings, for instance,
In that area that
we're
will
trying
have to have an
cover.
impact.
You know,
And
it's-
that could impact us greatly.
Well, do you remember at San Anselmo, there was a kind of a major flood twice, actually.
Right.
And
There is flooding in Mill Valley as well
Yeah.
over the course of the last decades.
It'll be very interesting to see what happens. So I wonder, like, okay, Mark, you do hard money loans. You can kind of make your own rules because these are government type, you know, with regular bank loans that are requiring this flood insurance. Do you require flood insurance?
No, we don't look at that. Again, we're not making long-term loans, so again, we're not really concerned about the risk on a 6 or 12-month loan of there, you know, being a flood in this particular area for this particular property.
So you actually
that's not
may
something we pay
benefit.
attention
You're
to.
actually probably smiling because of these changes in these loans.
Well, yeah, I think he smiles every
requirements.
time the government requires
Yes,
more and more
exactly.
on
Has to be a
confidential.
rule, yeah.
That's true.
I'm sleeping better at night.
Yeah. Well, you know, it's interesting because, you know, we were just talking about, well, you know, is this going to result in more foreclosures? I mean, already banks are hardly foreclosing on people who haven't made a loan payment in 3 years. So,
Yeah.
But on the one hand, you know, if you are someone, I mean, what can the bank do? And that's what's interesting is that usually on the way a note and a deed of trust are written on any real estate loan is that if you don't pay your property taxes, for example, they can pay them for you, advance the money, and then add it to your loan, and then
Well, they'll
maybe-
do the same thing with the flood
They'll
insurance.
do the same thing with
Yeah,
flood insurance, so
sure.
you may end up paying for it whether you like it or not. If
Exactly.
the bank, so it really depends on how harsh the bank's going to be. They may not actually physically foreclose, but it could increase your loan balance and increase your your monthly loan payments as a result.
That's exactly correct, and that's what I'm finding as well, that they'll increase the loan payment, they will pay it for you, and then they'll just increase your escrow account, so you will be paying for it one way or another. The frustration I have is through the legislatures, how they come up seemingly arbitrarily to hit people, businesses, with this type of insurance. There's really nothing to preclude them from doing it for any natural hazard. Right now in California, as everybody knows, we're in an extreme drought. What's to say that a year from now, in some areas where you've had tremendous wildfires,
Yeah.
that the insurance companies now come and say, or the mortgage companies say, now we have to have special premiums for this type of hazard in this area?
You know what? In reality, they don't necessarily even have to say that you're in that hazard. So, in other words, they could go to non-flood zones and just say, you know what? It's unfair to charge just the people in the flood zones, but we have to cover the whole
We're
thing.
gonna make
We're gonna make everybody
Well, that's what they
pay.
did. They
Insurance.
changed the mapping. So they
That's
said,
right.
you know what? Hey, you know what? This might happen 100
Yeah.
years
Well,
from
Or
now.
let's say me, I live on a hill. They could just say, you know what? Even though your place will never flood, we're still just going to add premium just to help cover everyone
It's kind of like
else.
kinda like
no-fault
just-
insurance.
yeah.
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 Or just because you fall possibly in an area that does have a flooding. There's areas in Corte Madera, San Anselmo is a great example
Oh,
where they
yeah.
have hilly areas, but they also have areas that are more susceptible to floods, and they're just going to map it all as
then
a flood
everybody-
zone,
that's
and
right.
everybody covers it.
So what's the advice? What do we do?
Well, I thought about that. There's-
Pitchforks.
Well, I think complacency is a really negative thing for everyone. Don't take it lying down. Do what we did. Contact your mortgage company. Contact your insurance carrier. Contact your local representative. Do everything that you can to be proactive instead of just letting your insurance premiums go up, your payments go up, now you're underwater, and now what do? Be very proactive and see how you can work the situation out and be vocal about it. I think a lot of times people are inundated with their own schedules, their own work, family, whatever, and they don't spend the time that they should to kind of react to some
Well, I'll
of
tell
these.
you, yeah, you get a $12,000 bill from 1,200, and you're going to react pretty quickly if you don't have the heart
Yeah.
attack
Yes.
first. Okay, Don Fitzpatrick, thank you very much. Stick around. We're just going to cut to a commercial break here. Okay, first commercial break, first trivia question. Again, the theme is music #1 hits of the 1980s. Arthur's theme, The Best That You Can Do. Who sang it? Call 888-912-1190. That's 888-912-1190 to answer this question. Arthur's theme, The Best That You Can Do. Who sang it? 888-912-1190. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. The Best of Investing. We'll be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, and Catherine Harris, CPA of Haradi & Karad. When we cut to the first commercial break, we asked this trivia question. Again, the theme is #1 hits of the 1980s. Arthur's theme, The Best That You Can Do. Who sang it? Do you know?
No clue.
No clue. Okay.
It's those two young kids who were wearing their pants on backwards, crisscross.
Crisscross. No, but you're close.
Christopher
Cross.
The other
Very
crisscross.
good. That's very good. Okay.
I think they were 1990s.
Crisscross.
Were they? Oh yeah,
Jump,
that's true.
jump.
You wear those things
I'm gonna bring
backwards.
you some
Wonder again.
overalls back.
Those guys wearing it backwards. They didn't know if they were coming or going. So now, Catherine, you got an interesting article to share with us.
You know, on the show, we keep on talking about mortgages and what was to come in 2014. And I saw this article, and it was a different twist. It was a different twist on the discussion. It read, "New mortgage rules aim to clarify and simplify." The first few sentences read, "It seems so obvious. You shouldn't qualify for a mortgage unless you can afford it." And I guess the government.
I'm steaming here.
I have to take my sweater off. I can feel it. For me, and I actually do, I can appreciate, obviously, the public in the United States got a little selfish, and we could not control ourselves, and something happened called the downturn, and so they had to step in, which usually that's what happens with the government.
We're
They
here
have
from
to.
the government, and we're here to help.
Yes.
Here to help us.
Thank you, Ronald Reagan.
And yes, and usually they have good intent. I can appreciate clarity.
I don't know about that.
Well, see, for me, like
That's fair enough.
clarity.
Well, Dodd-Frank was sold on the idea that something has to change. We can't let this happen again. And what was this? Banks were giving away money, making loans to people who couldn't afford to pay them, doing these nasty subprime loans with rate adjustments that they didn't, that people were unaware of, all this stuff.
Yes.
So here, this
that's-
the
So
Street article
it
says.
sounds lovely.
Yeah,
They do need
rules aim to
this.
clarify and simplify. If that were now, that may be the intent. That may be the positive spin they put on it. But the practical effect of the hundreds of new regulations, thanks to Dodd-Frank, have been, in my opinion, a complete disaster, and are going to continue to be a disaster through 2014.
So there's no clarity and
Yeah.
there's no
But
simplification.
in all fairness, though, the one thing they are right about, if they had done nothing, then we probably would still have these brokers just trying to churn these loans and give money out for no reason at all,
The so-called exotic loans
Exotic
with the pick-up
loans.
payments,
It's
or
exotic.
Pick-up
oh my
payment.
God, interest-only payments. And how
I pick
frightening.
0 as my payment. How's that?
Sounds. Why don't you give me money?
Yeah,
I'll
that's
stay in
right.
the house. And that, I appreciate there needs to be more clarity and there needs to be some simplification surrounding mortgages, the financial education of the general public has declined over the years.
I've heard that.
It is.
I believe it too.
Because you're gonna get me steaming on another
I know, I was
issue.
gonna say, I
you
get
don't.
too many
I see the
media,
smoke coming out of your ears there.
I've had people who don't know how to reconcile a bank account. Like, that is mind-boggling
Yeah.
to me. And I imagine to people in your generation, but that's how the people are they just don't know much.
College graduates, they come out and they don't know how to balance a checkbook.
Yes.
That's
They
great.
they're
Addition
they're
and subtraction.
it's amazing what education level you
I usually
needed
take
to
out my
have it.
protractor.
But I'm just amused by this. Is an
But,
article
yes.
on CNBC, and the author of this article, who will remain unnamed, is. I mean, you almost think, what's this guy, a mouthpiece for for somebody on the Frank Dodd committee? I mean, that's just. I don't know how anybody who really actually understands the practical applications of this myriad of regulations, how they could say that, because it certainly does not clarify nor simplify. It may aim to, but when has any new regulation passed by the government ever led to something being simpler or clearer.
Look at Obamacare. I mean, they just
Well, look at
they
our
ju-
taxes.
They do, they
Do
ju-
you-
and
do
that's
you
the
do your own
problem.
taxes?
Oh God! And even then, I'm like, I might need to check a little bit on that because there's always new things coming out. And you said it, there's so many rules that came under the act that there was no, it almost needs to be a one sentence law. We need to start, you know what we need to do? We just have to stop, we have to put a maximum number of characters that can be in a law.
But you know, in 1913, when they first came out with the tax return, it only had 2 lines. What was your income? And the second one was send it in.
Basically, and sign, and there you go.
Right.
Someone said it, this is I think the 100th year for the tax
Yeah,
return.
that's right.
Funny.
Let's celebrate.
You know, I'll tell you, with the Obamacare, I looked into it a little bit and talked to somebody who was a lot more knowledgeable than I. And the rates that I'm paying right now with Blue Cross are higher than what I would get with Obamacare. But if my tax return shows different than what I believe it will show, I might end up paying twice as much when they reconcile the tax return and say, well, wait a minute, if your income is X instead of Y, now you got to pay, like I pay like $500 a month for insurance. And if I go to Obamacare, I might be able to pay a lot less. But if I make a mistake with regard to figuring out my income, because I'm not a W-2 person,
Yes.
I might end up having to pay $1,000 a month.
You've
So
gotta be
it's
careful.
not worth it. Yeah, so I'm not gonna join.
I'm still covered by the company policy that we have. We have a Kaiser plan at our small business, and we did not have to do anything with respect to Obamacare this year because we were grandfathered in. But all I know, and this is my only comment really with respect to Obamacare, at least on this show, is that my poor medical insurance broker, the guy who makes a living being a insurance broker for health insurance policies to small businesses, if I get him on the phone, he's crying.
Yeah.
He is miserable. Those poor guys there.
They work very hard. They get
they're
paid.
wor- yeah,
I mean,
they're-
I've got the same license.
It is so
but
messed
all I
up
do
right
is
now,
life
he said.
insurance. I don't even
Yeah.
touch health insurance. I don't want to do it.
Now, is it because of the complexities that are happening,
It's
or because
because
they're
of the com-
losing? Are they losing
It's the
people to
complexity in the business
the
laws,
exchange.
and they just and they're losing commissions. They're going to be out of business, at the end of the day. And it's really too bad.
Yeah, but you can always call the government and find out what the
Oh
rules
God!
are.
And that's what is even more hilarious when they talk about it with Covered California and the government is the people who they educated or the people that were hired by the state to answer questions are extremely limited into what
Oh, yeah.
they can answer.
Well, you know what's funny? I heard
Here's the
this-
form.
I was listening to Armstrong and Getty, I think it was a couple of weeks ago, and they said there was a poll that said, how many people are for Obamacare? And it was like 30%. And then they said, okay, but how many people are for the Affordable Care Act? And it was like 70% said
Yes.
Didn't realize it was the same thing. Okay.
Which again speaks to the education
Exactly.
level
Exactly.
of the
You
public.
gotta
Makes you want to
educate-
hang your head and cry.
You got to educate the public. Okay, we're going to cut to our second commercial break trivia question. Here it is. Again, the theme is #1 hits of the 1980s. Who sang Mickey? Oh, Mickey, you're so fine. You're so fine. You blow my mind. Hey, Mickey.
No, I'm not going to
Hey,
get that
Mickey.
song out of my head.
And that song
Thanks,
was in-
Edward.
Yeah, you're very welcome. That was in 1982 and recorded on an
I was
MTV
gonna say
video.
8-track.
Yeah, an 8-track. There you go. Showing the MTV video shows her as a cheerleader. So it's a woman. By the way, I like 8-tracks.
Yeah.
They don't work anymore, but I like them.
So goes the tape player.
I know. That's true. I was
VHS.
just at my mom's house looking at I had a machine, and she had a thing there for both.
Oh.
8-track, yeah. Call 888-912-1190. That's 888-912-1190. Answer this question. Who sang Mickey in 1982 and recorded an MTV video showing her as a cheerleader? One more time, 888-912-1190. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. When we come back, the best of investing, we'll get into some very interesting emails with our other hosts here. Well, welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Catherine Harris. When we cut to the second commercial break, we asked this trivia question. Who sang Mickey? This is, again, 1980s #1 hits. Who sang Mickey in 1982?
I can even actually sing it, but I don't know who sang it.
Was
Go
it one of
ahead.
the Spice Girls?
Yes, Tony Basil. Actually, she was not a Spice Girl, but
No, she
Tony
wasn't.
Basil. Okay.
Pre-spice.
Free spice.
Wait, what? Every spice?
Pre-spice.
Pre-spice, that's true. Okay, we are going to get right into our emails here, and again, we're getting close to tax time here. So, Catherine, the email we received for you, since you're a CPA, why should I use a CPA instead of using an online service to prepare my tax return? That's a really good question.
It is a good question, and I'm gonna bring up a point that someone brought to me this weekend. If you see the two commercials for one that is I'm going to say H&R Block.
Yep.
We used to call them H&R Blockhead. But that's
yeah.
the
Who've left
movie
$1
called.
billion, what, 50 billion on the table? They're
They're
saying.
saying if they can fill up $500 at each state football stadium in the country, because
what's
that's
the-
how much.
That's the
money?
commercial.
That's how the commercials. If you did the tax return yourself, you left roughly $500 on the table on average,
for
statistically,
each
each person.
Okay.
And if you look at TurboTax, they say it's amazing what you can do by yourself. So you have these two commercials.
We should put them in a
that-
boxing ring. And
Yes,
see what they can do.
like okay, well, it's amazing what we can do by ourselves. We can leave $500 on the table, is what we're saying, which just speaks to the complexity of the tax code and the tax law and the growing need to have tax advice and the need to have somebody on your side thinking about you throughout the year when tax codes are coming out that could have an impact on your personal taxes.
Sure. I mean, how many times do you get somebody who comes to you after the fact and says, "Oh, by the way, I did X, Y, and Z," and you go, "How come you didn't call me ahead of time?"
All the time.
Yeah.
And you would think people would learn, but they
Yeah.
haven't. But you
Like
should,
at
and
the
you
wash
should be.
sale
And we are
malls.
great. And part of my actually was going to go into it is the requirement as more and more burden of retirement is put on individuals. We're both, in the 50s, 60s, 70s, you worked, you got paid when you retired. You didn't have to be concerned of how your money grew. As more and more people are responsible to put the money away, to fund into 401k, they're responsible with how that money's invested.
Fair enough.
We have to be more responsible and more educated about where our money goes. And we just talked about it, the clarity of Obamacare, the clarity regarding loans and mortgages.
Yeah.
Everything is getting more complex, and you now have to invest in basically creating your own arsenal. You need to have your CPA. You've got to have an investment advisor. You have to pay for those expenses, but understand that those expenses are people who are really looking out for you.
Well, when I was in school, they had the tax code of 1954. Then they came out with the tax code TEFRA for 1986. What are they working on now?
It's an ongoing every day. There's something
Yeah,
changing.
they don't,
Is
they
it
don't need
still
to
the-
have a major anagram for it.
Wait,
No,
is
exactly.
Is,
That's
it,
what it
is
is.
it still the 1986 code, or
I-
do they make it something else? I mean, it doesn't matter. because
Every year it
keeps-
changes, so I imagine it's this. It just they keep and it never
Yeah.
gets and anything government. They never take things away. Everything gets added on. There's more information. They always talk about maybe having this flat tax or a simple tax
Yeah.
or some type of, and never.
No, and then sometimes
I'm
some
betting
stuff
against it.
expires, but then they say, "Well, but we retroactively reactivated it." And,
Well, especially for 2014, and that's
Yeah.
maybe fine. 2013, you don't want to think about it, and it's all you're good for it, fine. But 2014, there's a lot of things right now that have expired that are set to expire in 2014. So when you come here
Yeah.
a year from now, educators aren't going to get their education deduction.
I mean, I'm presuming that, let's say, a student who makes a little bit of money, probably could do his or her tax return himself. But at what threshold do you find it's really important to really get a CPA to do that?
I really recommend it when you have you have a small business. If you have and you own a home.
Okay.
If you really don't understand it and you really want someone to walk you through it and be there for you, I've had people who literally just have a W-2, and that's
Yeah.
all but they want me to explain everything to them.
Well, there's certain things like with the home, they might have done some improvements where they get credits and they didn't realize it.
Exactly.
Yeah.
So generally speaking, once you get to having a home and you have some investments or you have a small business, it's suggested, I would advise that you have a CPA. And use them as a tool. You call them throughout the year before you make decisions, because oftentimes I had somebody call today. Oh, I can take this as a deduction. Should I pay it today? I was like, yes, you could have taken it as a deduction if you paid it last month.
Yeah.
So
Oops.
let's start planning for next year. So you can think ahead, but generally speaking, it's when you start to have your own home, you've got a couple W-2s, you own your own business,
Okay.
and you've got some investments.
How much of your business is refiling a prior year's tax return to go get a deduction that they didn't get?
You mean an amended return?
Amended return, yeah.
1040.
So oddly enough, not so substantial, because usually what we're getting are clients who already have CPAs. It's not often that we're getting somebody who
Interesting.
doesn't previously have had a CPA.
But sometimes you'll find the old CPA didn't really know what they were talking about.
Oh yes, which scares me. And I imagine you guys have that in your own industries. It's amazing what
Yeah.
some people, which is kind of my other question, or my talking point for the day. My yes,
soapbox.
my soapbox
Yeah.
is this arsenal of professionals that you should have, but also asking questions in their disclosures. Is make sure you know how they get paid. And that's something I think about Mark is he's upfront about
very
how
upfront.
and that's important.
Yeah.
If you don't understand how somebody gets paid, if you don't understand how they make money, you make money, they make money, ask questions. One, we get excited because then we just get to talk about our business, which is
Sure.
we enjoy talking about. But I want people to understand their taxes. I want them to understand why they didn't get much of a refund, or you need to plan and let's try to get some of these deductions in earlier next year.
I presume you don't charge based on the refund.
No, I don't.
Boy, wouldn't
No,
that
we
be
don't.
great?
Yeah.
That depends.
Or not. I mean,
Yeah, if you owe.
If we, like, that is not appropriate.
Well, you cut your hair, but it's
I did
still
cut
cute.
my hair.
It's still cute.
No, she's definitely cute.
I am.
Cutest CPA you'll ever hire.
She is definitely the cutest of the three of us here.
A
Oh,
younger
I was kidding.
looking Hillary Clinton.
Yeah,
No.
You're a lot better looking than
I
Hillary
can't believe
Clinton.
someone actually said that to you based on your haircut. That's
Yes.
just rude.
It doesn't even look like Hillary Clinton's though.
You're,
That's strange.
you're younger than her daughter, than Chelsea.
But see, that's good because then she's not an old fogey. She's somebody who's right there in the trenches,
That's
up to
right.
date with the code. You want to call Catherine Harris one more time at where?
415-461-8500.
Okay. We're going to cut to a quick commercial break. When we come back, we have an interesting question here for Mark about interest rates rising and how that could affect borrowers. Here is our third and final commercial break trivia question. Again, the theme is number one hits of the 1980s. What was the rest of Prince's band's name?
Oh.
So remember Prince, and he changed his
Yes.
name to some kind of a
Symbol.
Symbol, thank you. And then I think he changed it back. But I didn't know this. I thought it was just Prince. But there was actually Prince, and then there's the rest of his band name. Don't touch that dial. The best of investing. We'll be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hunt and Catherine Harris. When we cut to the third and final commercial break trivia question, we asked this question. What was the rest of Prince's band's name? So there was a band named Prince. Everyone knows who Prince is. What was his band's name? What was the rest of it?
Was it Prince and the Purple People Eaters?
No, but it's Prince and
Oh my God. P? No, I was
Prince and the Bee. That's a good
Princess
one.
and the Bee.
No, Prince and the Revolution.
Oh
that's
gosh.
I didn't know that. Okay.
Sounds familiar.
Mark, interesting email we received for you. If interest rates rise, will the rates you charge borrowers go up proportionately? Very interesting
Okay,
question.
well, let's give the audience a little bit of perspective on that in case you're a new listener. My name is Mark Hanf. I'm president and broker of a company called Pacific Private Money here in the Bay Area, and we're a private money lender. We make loans to real estate investors. Some people call it hard money, but I think we're kind of in a new era lending of privately funded loans now. We specialize in making loans to the real estate investment community. We don't do consumer home loans. We generally loan to real estate investors who are buying, fixing, and flipping. And so hard money has been priced throughout the last couple of decades fairly consistently. With the exception of when interest rates spiked, to 20% or whatever in the brief period during the Carter years. But I've been in real estate for 30 years, and we borrowed a lot of hard money 10, 20 years ago, and we were generally paying about 12% for it. And even before I got into the business of private money lending in 2008, I used to borrow regularly from time to time from a local company here in Marin County that was doing hard money loans. And one time he told me how they factored in the price. And he said, well, we take the prime rate, which, historically the prime rate used to like go all over the place. It'd go up, it'd go down.
Sure.
It's in the last 30 years, I think we've never had a period like we've had in the last, 5 years where
Yeah.
the prime rate almost never moves. But, the prime rate historically has been, fairly, I won't say volatile, but active. It changes. And so they used to price their private money at the prime rate plus 5%. So if the prime was at 7, which was not an unusual
Yeah.
number back in the day, they were lending the money out at 12. So is that kind of metrics going to return? I don't really know. Now if because again, in the 5 years that I've been doing private money, the prime rate's pretty much been the
It's
same.
been
It's been
steady.
It's been right around 3, and so I would say it wouldn't surprise me if some of my more experienced private lenders who've been doing it maybe for the last 20 years, if we see the prime rate, let's say, go up to 6%, might they say, hey, Mark, I'd really like to start lending my money out at 12 again, at 12% like the good old days, as opposed to the 9 and 10%, which we're doing now, to be a little bit more competitive in a marketplace where there's a lot more companies doing privately funded real estate loans than there were, say, 10 years ago. And the reason for that is because the banks really stopped making loans to real estate investors after 2008. They've focused almost primarily and exclusively on consumer home loans, making those, 3, 3.5, 4, 4.5. Now it's 4.75% consumer home loans. So the private money lending industry is really a kind of a different industry. It's almost a new industry that's evolved over the last 5 years in response to the void that the banks left in the credit markets when they left in 2008. So will rates rise privately? Private money rates rise in response to a rising prime rate? I would say it's very likely, but let's look at what's likely to happen in 2014. I tend to like to maintain a relatively short-term outlook. Trying to guess what's going to happen in 5 years is just silly. I don't even make a 5-year plan personally. I'm a guy that believes in, I plan quarterly and yearly in my own profession, in my business, and it's how I measure my business. We've been listening to a lot of people at the real estate events last couple of weeks talk about their predictions for 2014, and I would say on average I'm hearing predictions of mortgage rates for consumer home loans to be somewhere in the mid-5s at year end. I haven't heard anyone say yet that they think it's going to hit 6% in 2014. It would surprise me. The Fed has promised to try to keep a lid on interest rates. So in any event, I don't expect there to be much of a change. I would say that private money rates certainly through 2014 are probably going to stay right about where they are, and it's right around the range, the narrow range of 9 to 11%. That's pretty much where all of the loans that we make at Pacific Private Money fall
explain
into.
to the audience why these people are coming to you. Why are they borrowing at 9 to 11%?
Well, they're borrowing at 9 to 11% because they want to use leverage. They don't have enough money to pay all cash for real estate that they want to buy, fix, and flip. And so the only market is the private market, the private money market.
Why can't they
It's
go to
the
the
only
bank?
supplier.
Well, there's 3
That's
reasons
it.
they can't go to a bank. One is because the banks, can't react quick. Well, first of all, if you find a bank that will make you a loan, most banks aren't making investment property purchase loans. But if you find one, they generally can't loan fast enough. So really, that's the primary reason is if you could find a bank, if you were qualified for an investment loan, you can't close fast enough. Really, in this market, as we know, it's gotten inventory is not at levels of where it was years ago because there's just not enough people putting their homes on the market. So we've all heard that inventory is tight. The resale inventory is tight. That means the people who are able to buy a house that they think they can profitably remodel and flip, the ones that are getting the deal are the ones that are making no contingency offers. They're making it really easy for the seller to say yes. So they make a very aggressive offer, oftentimes with, maybe they'll make an all-cash offer, even if they don't intend to pay all cash. They know they're going to go to a hard money lender and get, a 70% hard money loan. But that's the biggest reason is the speed. Another reason is because a lot of oftentimes properties aren't in
Habitable
habitable condition. They're not move-in ready, or maybe they are, in theory, move-in ready, but according to the bank, who does their own appraisal, they look at it and go, well, this wrong is, and then that's wrong, and we're not going to,
It's
we're
missing
not
an
Their
outlet.
criteria is
Yeah.
more stringent.
Right, exactly. So that's really, in a nutshell, that's the reason why. And the reason why private money is priced the way it is not because I want to charge 9 or 10% for a bank loan. It's because that's what motivates. That's what motivates my private individual investors, the people whose money that I am utilizing to make these loans. That's the marketplace. The marketplace in the San Francisco Bay Area is for people who want to make 8 to 10% on their money. They're willing to lend it privately. There's a certain amount of perceived risk, even though I think it's one of the least risky investments you can make, and make 8% on your money.
Yeah.
But
Well, because your loan to value
And
is so low.
that's actually, I think, even after commissions too. That's after all their fees. That's actually what the
That's
return.
net.
That's
That's
the net return.
Yeah. In fact, you have a fund that
we
people
do.
are
We've
allowed
got
to
the
invest.
Pacific Private Money Fund, which was launched last year in response to the fact that I was getting so many phone calls, oftentimes thanks to this show.
Yeah.
People were calling and saying, how do I earn 8% or more on my money? And so I could only place so many individuals into individual notes, and it got to a point where I was getting so many calls and so much interest in these mortgage-secured investments that we created a mortgage pool fund called the Pacific Private Money Fund, and last year it paid, the average payout was just under 8.6%, secured by real estate. It's, I guess one way to look at it, it's much like a mutual fund of real estate secured loans. It operates very similar to a mutual fund, with a few exceptions, noteworthy exceptions, but we've got very well secured. Our average loan to value for all the loans in the fund right now, as we are on the show, is 61%. So it's very well secured.
That's very secure, very
conservative.
yeah.
Yet even though it's got it's got the safety and security features of the fact that it's all backed by mortgages. It's 61% loan to value based on the purchase price. The effective loan to value actually is even a bit less than that if you understand that our borrowers are buying homes at some of them are buying them at wholesale prices,
And they're
they're
improving
improving
it,
them.
yeah.
Oftentimes, if we start out making a 70% purchase loan, it ends up being below 50%.
Where are the
loan to
loans?
value.
Where are these loans? Are they just in California?
Mostly, well, yes, just in California right now, and mostly Northern California. That's our market. I mean, we're fairly well known in the San Francisco Bay Area. We probably write more loans than most of the existing Northern California loan brokers. We've been in business for a little over 5 years, almost 6 years now, done over 600 loans. In fact, we ended the year last year, we wrote about $50 million in loans last year, and our average loan size was just under $300,000. So we're
And before
working
we
with
get
a
to
lot
our
of real
thoughts
estate.
for the day, what about liquidity? Because you said it's like a mutual fund. How do people get out if they invest with you and then they say one day they need money for a wedding or whatever?
We designed our fund with a 2-year investment minimum. So after 2 years, first of all, there's no loan going in and no fee coming out. So after 2 years, you can redeem without a fee. But if you have to have your money within those 2 years, there's a modest prepayment penalty. You still will have made a nice tidy yield during that period of time. Let's say you kept it in the year. But we're trying to discourage people from treating it like a money market account.
Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.